Ladies and gentlemen from around the world, welcome. You are watching Arise News. We are live from the KPMG Insight Center in the commercial capital of Africa's largest economy, Lagos, Nigeria, bringing you Budget Day 2024, brought to you by KPMG and Arise TV. I am one-third of the triple threat this morning, Rosis Odiri.
And I'm Rolake Akinkube-Filani, and this is the second edition of the KPMG Arise Budget Day, and you're in for a treat, so stay engaged.
And I am Bosun Amofoye, and this program focuses on what matters for the country's new horizon for 2024.
28.7 trillion naira. That's what we're going to be discussing as we break it down. We are happy to be joined by the public sector in the form of the Honorable Minister of Budget and Economic Planning, Abubakar Atiku Bagudu. Also, the private sector is with us in the form of Tilewa Adebajo, the CEO of the CFG Advisory. We've also got Mr. Austin Avuru, who is the chair of Avuru Holdings, and also very, very happy to have Chinwe Egwim. She is the chief economist at Coronation Merchant Bank.
And that's not all. Nigeria's foremost think tank is here. The chair of the Nigeria Economic Summit Group, Mr. Olani Yusuf, is joining us right here. We also have from the power sector, the group managing director of Sahar Power Group, Mr. Kola Adeshino. And last but by no means least, executive chair and co-founder of Sahel Nutrition and Consulting Limited, Ndidi Okonkwo Umuneli.
That's correct. And so there's going to be a whole lot that we're going to be getting into. So sit back. And one more thing, you at home, we want you to be involved in this Budget Day 2024. So we're going to be using the hashtag KPMG Arise TV Budget Day. One more time, hashtag KPMG Arise TV Budget Day on X, formerly known as Twitter, or you can also tag at Arise TV and also tag at KPMG_NG for Nigeria. Send in your comments, send in your questions, and we'll read them live on air. So sit back, get comfortable. We'll be right back.
Well, to get us started on the overview of the budget and what to expect in 2024 is the senior partner of KPM Nigeria and CEO of KPMG West Africa, Mr. Tola Adeyemi. He's going to be taking us through the key highlights of the 2024 budget. Over to you, Mr. Tola Adeyemi.
Thank you very much, Rolake, and good morning, viewers. Welcome to the KPMG Insight Center. So let's get into the 2024 budget. What are we looking at? It's a 28.7 trillion naira budget. It's significant because when we compare this to last year's budget, it represents a 32% increase in terms of expenditure. Just like last year, this year's budget is a deficit budget, which essentially means that our planned expenditures will exceed our planned income. But unlike last year, we're seeing a lower level of deficit in comparison to last year's budget, which is indicative of the fact that government is taking steps to achieve better fiscal consolidation. But how come the deficit is lower? In answering that, you don't have to look too far. Let's look at what's happening on the revenues. So on the revenue side, we're planning to increase revenues by 87%, whereas expenditures are going to increase only by 32%. So that's why the deficit is lower. 87% increase in revenues. What's driving this? When you look at the composition of the revenues, what immediately jumps out at you is the increase in oil revenues. So from a planned oil revenue of 2 trillion last year, we're now looking at 9 trillion this year. That's over a 300% increase. Is this overly ambitious? In answering that question, I think we've got to unpack what are the drivers of revenue, especially oil revenue. So you're talking here about oil prices, you're talking here about production volumes, you're talking also about the exchange rate that's been used to translate it. The other factor that comes into this is the subsidy, the existence of subsidy, which impacted the 2023 figure, and which we will see to what extent it would impact this 2024 figure. So when you look at the revenue number in terms of saying, is it achievable? I think there's some vulnerabilities in that number. The production volumes are a challenge, and later on in this program, we'll be having a deeper discussion around the feasibility of achieving the production volumes. There's an assumption here that Nigeria will produce on average 1.78 million barrels per day. This is coming from last year's average, which I believe was around 1.3 million barrels. To address that, you know the issues we'll need to deal with. We'll need to deal with the issues around increased production, which is getting more investment into this sector, as well as blocking oil theft, essentially. Another line I'd like to draw attention to is what's happening in non-oil taxes. So you see that going up by 45%. Non-oil taxes refer to company income tax, VAT, customs levies primarily. An increase of 45% in that, I think it's possible. It's possible if we're able to block all the leakages. In other words, bring additional entities into the tax net, perhaps using technology. So that's what we're seeing on the revenue side. Let's take a closer look at expenditure. Capital expenditures are up. On the face of it, that's a good thing. But when you dive deeper into this number, you see that it's about 1.3 trillion or so that represents investment in infrastructure. The rest of it are investments in things like buildings, in vehicles, etc. Things that are other than infrastructure related. On the non-debt recurrent expenditure, I think there needs to be some commendation here, because you can see a clear attempt to try to keep the level of increase in this below inflation. So this signals an attempt to more properly manage that particular line. The big elephant in the room, which is the subject of much discussion, is the debt service number. And when you look at this debt service number in relation to revenues, I believe you're looking at about 45% or so of revenues. There's a rule of thumb in public financial management that says once that ratio goes above 30%, then you should get worried. So we're way above that. So we have a deficit. How is this deficit to be financed? Well, essentially, the answer is simple. The deficit of 9 trillion is going to be financed primarily by borrowing. It's going to be borrowing mostly in the domestic market. Understandably, the level of additional foreign debt, there's an attempt to curtail that because of the exchange rates, the interest rates impact. But what are the implications of the high level of domestic borrowing on the local markets? What are the implications for the private sector? What are the implications in terms of what that would mean for interest rates? We'll be talking more about that during the course of this program. So what should we be expecting from this budget? What are the areas that have been prioritized? Security and defense, big area of priority. Almost 12% of the budget is going on security and defense. This is understandable because there's a clear nexus between security and economic growth. You can't have economic growth in an environment of insecurity. So government has indicated that they intend to spend a lot more money in this area. And we all know the impact of the kidnappings, terrorist attacks that are happening in different parts of the country and what that does to business confidence and economic growth. So security, a big area. Infrastructure is another big area of spend, where 5% of the budget is being allocated to infrastructure. We've made the point severally, of course, that the amount of money that Nigeria needs to be spending on infrastructure is way above this amount. So the key question is how to mobilize additional private sector funding to help to do the investments that are needed in the infrastructure space. Then you see the focus on what I would call the human elements, the healthcare, education, social development, and poverty reduction. You also see that these areas are getting a significant proportion of the budget. There's no doubt that given the current economic conditions, the people are groaning. And so government very rightly is looking at spending money on social development and poverty reduction. But we all know the recent controversy that has arisen in that particular area. So there's work to be done here, I believe, on the part of government in terms of restoring the confidence of the population in terms of the money that's being spent to lift people out of poverty. So the 2024 budget, there are various issues to be unpacked. I've listed here 7 of those issues, but there are many more, and I look forward to these coming up during the discussions we'll have later today. The first one, revenue enhancement. A lot has been said about the fact that our problem in Nigeria is a revenue problem, that we've got to do more to generate additional revenues on the part of government. Government has taken a step here. We have the government's tax reform and fiscal commission that was set up, which has come up with a set of recommendations. I believe they submitted a 30-day report that contains certain recommendations. We need to see the action being taken on those recommendations. The second area is debt sustainability. I spoke earlier about the fact that the debt service levels as a percentage of revenues are very high. There's a plan to borrow even more money. So as a nation, we've got to be looking at the sustainability of Nigeria's debt stock. We certainly don't want to go the direction of the countries that have defaulted on their debt. So there's an urgent need to look at debt sustainability, the restructuring of that debt, and any other things that need to be done. I'll talk briefly on prudent fiscal management. Here, what we're talking about here is the signaling from the top by government, the signaling that these are tough economic times, and therefore the way in which government itself is managing its finances has got to reflect that. We've seen some recent moves that have been announced by government. I believe the population wants to see more of such moves. Ease of doing business, big issue, because we need to push growth in Nigeria. To push growth, we've got to bring in more foreign investment. We've got to make the environment suitable for businesses that are even operating here already in Nigeria. Infrastructure financing, I've spoken about that. Security, I've spoken about that. And social development, health and education, I've spoken about that as well. So these are all areas that will need to unpack, and I'm sure the deliberations we'll have today will throw more light on those areas. So thank you. Rotus?
Mr. Tolademi, thank you so much for the breakdown. This wall is my favorite part of the Insight Center, with how you break down all these numbers that are very important to the economy. We thank you so much for setting the stage for today's Budget Day. Once again, it is the Budget Day 2024 right here at the KPMG Insight Center in Lagos, Nigeria. Up next, we are going to be speaking with the Minister of Budget and National and Economic Planning, Minister Bagudu. Don't go anywhere, I'll be right back. Welcome back to Budget Day 2024, brought to you by Arise TV and, of course, KPMG. We are live at the Innovation Center in Lagos, Nigeria. Once again, Rotu Sodiri here. And up next, right now, we have, of course, a conversation on a budget in transition. What to expect out of that 28.7 trillion that the senior partner Tola Adeyemi already broke down for us. We are happy to have the Honorable Minister of Budget and Economic Planning, Minister Abubakar Atiku Bagudu. You're very welcome, sir. Thank you so much for joining us. So, Minister, I want to set the context for our conversation in terms of how the government's macro view, just looking ahead, plans to implement these budgets for the sake of the nation, as far as what to expect. When the president presented the budget to the National Assembly, he gave 6 deliverables. 1 was job-rich economic growth. 2 was macroeconomic stability. 3 was an enabling business environment. 4 was human capital development. 5 was reducing poverty. 6 was access to social security. In terms of this budget that we've already looked at, how are you intending to deliver on those key areas?
Thank you. The budget of renewed hope, which is the 2024 budget that Mr. President signed into law on the 1st of January, derives from the renewed hope agenda under the manifesto under which he campaigned and got elected. And in itself, the renewed hope agenda drew from the national consensus that have always existed that we need to grow at a faster rate than we had been growing. The most recent of such consensus is contained in Agenda 2050, which is a long-term perspective plan that was drawn on by, among other, private sector, public sector, subnationals, federal, civil society organizations, and other stakeholders. And that recognizes that we need to grow at a much higher rate of growth than we have been experiencing in the last decade and a half. And equally, we need to mobilize private capital because the Agenda 2050 estimated that we need investments in the sum of, at a minimum of at least 100 billion US dollars, with less than 20% of it coming from the public sector. So meaning most of it should come from the private sector. So rightfully so, President Asiwaju Bola Ahmed Tinubu, as contained in the renewed hope agenda and the 8-point items of the agenda, says that we need to grow higher. We need to deal with food insecurity, agriculture. We need to generate economic growth and poverty eradication. We need to include all. We need to provide access to capital. We need to enhance transparency, accountability, and rule of law. And to do this, and given what one famous Nigerian, Charles Soludo, described as a very comatose economy that he literally inherited, we need to make choices that are different from choices that have been made before or choices that have been delayed. So, not surprisingly, on day one, day he was sworn in, he said distortions have to go, fuel subsidy distortions, and later on foreign exchange subsidy, and the institutional realignment that the Ministry of Budget and Economic Planning needs to be separate from Ministry of Finance to sanction the fact that planning and our budget should emanate from a plan, and we must maintain a plan, and that institutional alignment is what brought the division, that a plan-based budget, which is part of what the 2024 budget is, and a budget that will support the restoration of macroeconomic stability. And it is such restoration that we believe will give the private sector the pride of place or confidence that they can invest. So removal of distortions, fuel subsidy, foreign exchange market, rule-based participation, and in the 2024 budget in particular, reduction in deficit. Well, it might not look a big number, but in terms of in percentage terms, a drop from 6.11% debt to deficit ratio in 2023 to less than 4% in 2024 is a significant number, and it is being noticed by investors. In all the three rating agencies around the world that have commented, that have improved their outlook on Nigeria, commented, among others, about that significant improvement. Equally, the budget provides for an increase in capital expenditure, which has been very difficult to achieve. The chart that was very ably presented by Tola showed an over 9 trillion naira. But that's even is understated by the fact that if you disaggregate the statutory transfers, they also have a capital element, which in total now will bring capital spending to almost 11 trillion. And that to us is very significant because that's about 39% of the budget. And what it meant is that we are putting money in the priority, more money in the priority areas, both in relative and in absolute terms. We have both in the supplementary appropriation that preceded the budget and in the budget provided more for national security and defense, so that those economic activities that are impaired by the perception or by actual insecurity will quickly dissipate, and we can mobilize domestic production as quickly as possible by, among others, increased spending in agriculture and food security, increase spending in infrastructure to help with the logistics, and not ignoring that we have to invest in human capital. Education spending had gone up, health spending has gone up. We have even provided, and Mr. President was very proud of it, a 100 billion naira school feeding fund, which is to support both the retention, mobilization of our children and remaining in school, and even begin to address the gray matter under investment, which is nutritional deficiency that is being experienced by a significant chunk of our populace. Equally, investment in housing, power, steel, as well as innovation. The science and technology spending has gone up, digital economy, and the creative economy, and as well as provision of funds that are to support the de-risking of some sectors, and even provided the needed impetus for growth. Example, consumer credit, a 100 billion naira fund is provided to help mobilize and crowd in and de-risk consumer credit, so that the manufacturing sector can worry less about customers who needs to pay upfront.
Minister, I just want to jump in here. Just real quick, you mentioned, my second question to you, of course, is, okay, you've got the vision, you have what you're planning to do, but then there's vision and then there's the reality, right? You mentioned domestic manufacturing. I want to use an example using defense. the 3.2 trillion that's been allocated, as was shown in the chart there, use whatever exchange rate you want, whether it's the 874 on the NAFEM window from yesterday or 1002 of the parallel market, it comes out to about $3 billion. The Chief of Defense Staff, General Christopher Musa, he was on Arise News. We had an exclusive with him after those unfortunate bombings, the accidental bombings in Kaduna, in that local government. And he said, and I quote, there is the amount that is allocated, and then there's the amount that we get. And he says, I was speaking to my colleagues on Newsnight, the segment that we had him on, where he said, I challenge you to ask how much is allocated. And he gave an example. And he said, for Tucano jets, the fighter jets, about 12 of them cost $600 million. If you add in other items that the military needs, you're pushing to almost $1 billion, right? So you've got a budget allocation, and that's recurrent expenditure and capital expenditure. I'm just lumping the two of them together, of about $3 billion, and yet just your equipment for the military is close to almost 30% of that amount, right? Without adding overheads and everything else. And he also said something very key. He said that our lack of manufacturing capacity means that we have to import all these military equipment from overseas, which also now puts pressure on the exchange rate. So the reality, Honorable Minister, is the vision of the budget matching up with Nigeria's realities as we see them today?
Well, I think maybe that's an example that maybe can be explained differently, because when you talk about a jet, equipment, these are amortized over a period. So if I have spent a lot of money to procure a jet, then in fact my capital spending for that item should come down in the preceding years, because to borrow from that example, the capital spending is something that maybe, and I think I'm on firm ground saying it in this room, that is amortized over a long period of time rather than in just one budgeting year. What it calls for is maintenance and maybe now increasingly software upgrades. But if you are saying that maybe we need more spending, yes, I'm not, because our spending as a proportion of our GDP compared to other countries is still very small, which is a function of the fact that compared to countries that have close to collect 50% of their GDP as revenue, we are still collecting about 10%, even though a presidential tax reform committee has been put in place to take it to at least 18% in the next 3 years. So are we under spending? Yes.
Okay, fine. More on the fundamentals in terms of the metrics for the budget. So exchange rates, I know we moved from 750 to like 850. You've got, I think you're looking at inflation for 2024 of about, I think it was 21% or so, at 28. And also revenues. Again, when the KPMG senior partner and CEO of KPMG West Africa was putting up the revenues, I have to ask you about the revenue side now. We are projecting 1.78 million barrels per day of production, right? Again, Arise News spoke with Mr. Heineken Lokpobore, Minister of State for Petroleum Resources, I think for oil, and he said you're going for 2 million, right? Now we did like 1.2 last year. Again, is that realistic? Are you realistically expecting to get to, maybe we can do 1.7 or even 2, and how are you going to get there to bring in the revenues to support this budget?
We believe that our budget should challenge all of us to do better. People should work hard to even earn their jobs. We have done it before. We have produced to that level, and there's no reason why we should not. So, Mr. President's vision is that we should be bold, we should challenge everyone, and we are not callous in that assumption. We believe that the security gains that are being made, the efforts that are being made to check insecurity, and even other forms of tools that are being used to limit what is available for the Nigerian populace that are being checked, will all bring to bear. as well as increased investment that proposals that we have seen and actual investment that have come in, we are confident that we will challenge everyone to ensure that we produce at least to that level. And having in mind that in our oil sector, there's production does not even count for the OPEC quota, but is nevertheless valuable and will provide equivalent to the barrels we are looking for.
I want to ask you about stranded assets. It's been projected, I believe, by the chair of the Presidential Committee on Fiscal Policy and Tax Reform. Nigeria has an estimated, I believe, about 80 trillion of stranded assets, which could yield about 10 trillion of revenue on an annual basis. I want to ask you about the plans of Nigeria to utilize those stranded assets to bring in revenue, because I want to use Egypt as an example. Just last November, Egypt, by selling stakes in tobacco, steel, and other assets, Egypt has generated about $2 billion, and they're planning to get more, and they have an IMF program, and everything is part of their program with the IMF and so on and so forth. So what are the plans for those stranded assets that are just sitting idle that we could use to generate revenue? What's the movement
I think
there?
the first institutional reform that has taken place is the Ministerial of Finance Incorporated, which is very well and popularly known as MOPI, has been strengthened and has been given clarity that all stranded assets or government assets that are not put to good use should be identified, should be made available for potential investors, whether in partnership with Ministry of Finance Incorporated, as well as the proposed Ministry of Petroleum Incorporated, which will also do the same for assets in the energy sector. And the board of the Ministry of Finance Incorporated has been strengthened, and they have been very aggressive in the last few months in terms of doing identifying assets and marketing them to investors.
So also I want to ask you about the cost of running governments, which of course has been brought up. You've heard all the headlines. I don't need to rehash the headlines to you, SUVs and things like that. How serious, I mean, of course, personal finance, you either want to raise your revenue or you cut spending to get what you need to do, get where you need to get to in terms of targets. So what are the concrete plans to cut spending in order to make this budget a reality?
Well, the first one is it shows that we tamed the growth in recurrent, non-debt recurrent expenditure, which is a significant indicator. And we are interrogating all other contributors to the recurrent. But one of the major issues has been, over the years, growth in personnel cost. Even though there has been numerous reports, also a very significant report that shows that maybe we should have institutional realignment so that government efficiency will increase. And I'm sure in the 2024 fiscal year we will see measure to implement that, which will support further reduction. But a constraining factor, and it's always good to say that when, especially in a situation where you are fighting insecurity, you need more boots on ground, so as the saying goes. And because people are ordinarily posted outside or undertaking duty outside their normal postings, you find that, again, allowances that you need to take care of them literally become inflexible downward. But that is not to say we are unmindful of more measures that can be taken. Mr. President, just to further demonstrate and warn that he meant business, just announced additional cost-saving measures by the president, vice president, and other categories of public servants. And we'll be seeing more of that during the year.
Honorable Minister, how quickly do you think matters can move in order to get this budget going? Because the reason why I ask is that we're already in 2024. 2027 is an election year. So really, you've got this year, probably 2025. We can argue if 2026 things can get going. Is there enough time to make a significant impact with this budget on those 6 items I mentioned earlier in the country?
Certainly. The team is determined under the able leadership of Mr. President. On signing the budget, he left nobody in any doubt that if any team member feels he cannot contribute to that, maybe he should excuse him or herself. That is as serious as it can get. And those who know Mr. President very well know that he meant what he says. And so people are, again, in the signing ceremony, he said that ministries, department, and agencies should take responsibility. And he meant it in the most serious. And these things are achievable. It just demands on all of us, particularly public officials, to ensure that we put in the extra effort to achieve those targets that are set forth, and they are achievable.
Are the ministries, is there a handshake between the ministries? And I just, or are they working in silos? For instance, the ICT ministry, for example, the minister of, that is Dr. Bosun Tijani, you need electricity for what he intends to achieve with broadband connectivity, internet penetration, and all the things he wants to do with the ICT and digital economy. You need power for that. So and you are at the head of this as the Minister of Budget and Economic Planning. You're overseeing all this. So is there a handshake where Bosun Tijani is talking to the Minister of Power, Dilabo, and saying, hey, listen, this is what I need? Is there synergy between the ministries?
Obviously, there are 2 coordinating ministers. A coordinating minister for the economy, in the person of Olewale Edu, who actually said I should offer his apologies. As we speak, I'm sure he's on a road, maybe between Kaduna and Kano, seeing what is happening to the road infrastructure as part of that coordinating mechanism, and as well as a coordinating minister for health and social service. There are structures that have even been brought in and enhanced for the team to work. But just like as everyone who observes team formation knows that even if you bring the best team members, it takes a while before they practice the team building is coherent. So I believe that Mr. President has provided the avenue and the institutional structure for the team to work effectively together. And the team are getting to know each other very well, and the teamwork is.
Minister, as you can see from here, I have a whole list of questions, but we're out of time, so I just have to wrap up. Do we have a revenue or spending problem? I have to throw that to you finally before we wrap up.
What answer? 3 months ago, Mr. President directed me to chair a meeting of a visiting European Union team of commissioners led by the Internet Commissioner for Partnership. And while we are waiting for the program to start, one of our, on the Nigerian side, told her proudly how we intended to collect more revenues, moving it to 18%. She said she's from Ireland, and she said she's among the lowest in Europe at 30%. That we need to be quick, because sometimes there are taxpayers cannot understand why they are giving money to those who will not be able to collect revenues from their own people. So that's just, I think that underscores our revenue challenge has been there, and we have recognized it. We can do better, and we have a president who is very clear. He is very profound in the way he thinks, and his ambitions are realistic. And we believe we will double this economy, we will collect more revenue, even without increasing tax rates, so that public investment will improve.
Minister of Budget and Economic Planning, Honorable Bagudowi, thank you so much for taking the time to talk to us today. Thank you so much, sir.
Thank you.
You're watching, of course, the Arise TV and KPMG Budget Day 2024. Up next, we've heard from the government side, it's the private sector coming up next, so you don't want to miss that. We'll be right back. Welcome back to the 2024 Budget Day, brought to you by Arise TV and KPMG. We are still live at the Insight Center here in Lagos, Nigeria, and we are about to have a macroeconomic analysis of the budget. And we've got two guests who, frankly, I don't even think I need notes for this segment, because we talked to these two individuals several times on the Arise News channel across several segments. I'm very happy to introduce Mr. Tilewa Adebajo, who is the CEO of the CFG Advisory, and also Chinwe Egwim, who is the Chief Economist at Coronation Merchant Bank. Gentlemen, thank you so much for joining us. Happy for you guys to be here. Chinwe, let me start with you. We've talked about the we've talked about the vision and then the reality of this budget. In your view, looking at the budget, looking at the numbers, what would you say the top 3 priorities for government should be? What do you think they should be, Chinwe?
Well, let me start by saying that when you look at the budget, the benchmark assumptions, they are attainable, but a whole lot of work needs to be done. And so when you look at indicators like oil production, when we consider some of our in-house projections, some of those projections are slightly lower. But let me answer your question to be succinct. Top 3 priorities from my vantage point would be 1, economic diversification. I know that that's an anthem right now. We've been saying it for years. But the government really needs to look into economic diversification. There are sectors like agriculture, and I'm speaking from the perspective of the national accounts, which, by the way, I believe should be rebased and refreshed. But agriculture, and not just farming, smallholder farming, but looking through that value chain, there's so much potential that's still untapped in that sector. There's mining, there's specific segments within manufacturing as well. And of course, my favorite, which is the orange economy, that's the creative industries. I think the government needs to really look into that when it comes to diversification. There's so much talk around boosting non-oil revenue as well as non-oil exports, and this is the way to go with regards to that. The next one would really be infrastructure development. Energy is important. It's a lubricant. It's something that's going to fall other sectors. When you look at the national accounts, non-oil economy accounts for about 90%, right? Just from a statistical perspective, and the oil sector accounts for about 10%. But the oil sector indirectly accounts for 40% or lubricates at least 40% of other sectors. So it'll be good to see the energy, the power sector, improve, because if we really want that industrial takeoff that we keep talking about, we can't do it without power. Infrastructure, roads, logistics is important. Ports. We need to also look into to ports management, improving what's going on there, because if we're talking about improving exports and trade, we would not be doing ourselves justice if we're still having issues with that area. I think the last one I would mention would be human capital development. We haven't really received new figures with regards to unemployment rates. What we have in the public domain is still 33%, which a handful of people believe that is significantly higher than that. And it's just interesting because there's so many job vacancies, right, that people can't fill because they don't have the skill set. So human capital development is important. Drilling it down, I would also say that there should be some kind of focus on the blue-collar economy. I think that segment has been ignored for too long. That's where you have your plumbers, your welders, your carpenters. I think that we should be looking into how to improve output from that segment. Revising the curricula of schools is very important. Most of them are outdated and do not reflect economic realities. So I think these are areas that they should look into to help with driving the objective of this renewed hope budget. Thank
you so much, Chinwe. Tilewa Adebajo, let me bring you in here. So that's priorities. What about opportunities? Do you see any opportunities in this budget as far as what industries can expect from the government? What do you see?
Well, let us take a look at it from a global perspective of the budget. The budget is just about 9% of our GDP. So a budget of under about $30 billion, GDP is about $390 to $400 billion. So the opportunity more is in the policy side of things. What sort of policies will the government implement that will open up the economy? I think, as Tola mentioned in his opening statement, there's issues of debt sustainability that we need to address urgently. So it's more about productivity within the economy and trying to achieve growth. And I think it's quite more the policies that will provide the opportunities. The Honorable Minister mentioned MOFI and the proposed Ministry of Petroleum Incorporated also. The opportunity lies within those two agencies, within the privatization. I think government needs to kickstart their privatization process. They need to also simplify the concessioning process, because we have the ICRC, we have the BPE, and between the ICRC, BPE, the Ministry of Finance Incorporated, and the Ministry of Petroleum Incorporated, if government can get these agencies doing what they're supposed to do, then I think we'll see some value added, because it's quite clear from the debt profile, as you've seen, by next year, the debt service at 11 trillion will exceed both capital and recurrent expenditure. So government really does not have much more to spend. It will have to depend, as the minister has acknowledged, on the private sector to drive the economy. So you need to privatize, you need to concession, and you need to let government, and there's Infracorp, which is another company. So government needs to get these agencies working at optimal levels to be able to get private capital into government. Productivity is an issue. Foreign direct investment is at an all-time low, less than $200 million. And we need to understand the two big projects coming through. LNG Train 7 is $6-7 billion. And they've made an announcement they're not going into LNG Train 8. And LNG's Train 1 to 6 is suffering from supply of gas. So productivity issues. Dangote has finished his $18 billion refinery. According to information reaching us, he's already financed that with his balance sheet, and he has less than $3 billion in debt on that. So what is the Dangote Group doing to be able to bring on another $10 billion investment? BUA, we know, is going into another refinery project and has made some investment commitments. We're hearing something about the Chinese company going into steel. So what is important is that the Minister of Industry, Trade and Investments needs to come back to be able to show us, and government needs to be able to put in the right policies that will not only attract foreign direct investments, but more importantly, local direct investment.
Yes, indeed, very interesting discussion there. I'm going to come to you now, Chinwe Egwe. Mr. Adebajo has been talking about the debt profile, and we know one of the main points of the budget over the years has been the fiscal deficit. Nigeria is having to borrow to finance that deficit. What can the government really do in 2024 to show its commitment to really managing the fiscal deficit, given the challenges we faced over the years with tax revenues?
Yeah, well, thank you for that. And it was really interesting listening to the Honorable Minister's segment, because he did throw some lights with regards to that. Fiscal discipline is important. That's number one for me. I would say also that the target, the revenue target, it is ambitious. And we are all excited to see this, but like that implementation willpower, we hope that it is there. So boosting non-oil revenue is another, aspect, because most of these ratios, the debt service ratio, that for debt to GDP and all of that, some of them are affected by the revenue figures, right? And so boosting non-oil revenue is key. I would also say that allocating funds that they have borrowed to projects that actually show significant returns is also important. So yeah, I think those would be the top three things I would say with regards to managing that fiscal landscape, because really the revenue segment or the revenue component is important for this year's budget.
Yeah, you talk about the quality of spending, the allocation of funds, but you also talk about boosting non-oil revenue. Just very quickly on the boosting non-oil revenue, one or two key things that you think absolutely must happen there.
Well, you mentioned tax already, so I would say not really concentrating on an increase, but more expanding that tax net. I think a lot of work needs to be done there. And also just trying to formalize the informal. The informal sector is huge, and so deliberate efforts towards formalizing the informal would also help with generating additional extra revenue that the government requires.
Yeah, indeed. So, Mr. Adebajo, just on this debt issue, we've talked about over the years the quality of government borrowing. We've also talked about which institutions are really long-term sustainable partners insofar as Nigeria's debt requirements or borrowing requirements are. What do you think that strategy should look like? Multilateral lenders, bilateral lenders? What should the strategy for Nigeria's debt management look like?
Well, at the moment, Nigeria's debt profile is about $130 billion. If you add the deficit that is coming up from this year's budget, we're looking at an additional $10 billion. Then you add the additional $1 trillion the National Assembly put onto this budget, which also has to be financed. So the actual deficit financing is now 10 trillion naira. So by the end of this year, we'll have a debt profile of close to $140 billion. Now, clearly, this debt is becoming unsustainable because you get to a stage where you've maxed out your credit cards. And I think that's the situation with Nigeria right now. So what we need to focus on this year is the fact that the key risk to us is our 30 trillion ways and means financing. 30 trillion naira of ways and means financing, 7 million was added between May and December. 7 trillion which has come out. 23.7 trillion of that has been securitized, and in the name of central bank, because 70 trillion cannot enter into our capital markets. We don't have the capacity. So what I think is important, first of all, is we need to have resolution to the ways and means, because right now securitization is illegal. So what the president and the National Assembly do not have the powers to securitize ways and means. The powers they have is to post remedial legislature to either amend or repeal the relevant sections within the CBN Act and the Fiscal Responsibility Act to be able to allow how we will resolve the 70 trillion. So we need to resolve that, because you cannot put 70 trillion into the capital markets today. Government cannot borrow that. So once you resolve that issue, then your capacity improves significantally. Then we need to restructure the local domestic debt, and we also have to restructure the international debts. We need to talk to our multilateral creditors, the Eurobond holders, to see how we can do that, to give us some breathing room based upon our cash flows. And I think we've said it clearly that the silver bullet really is that oil is now $70 a barrel. So Nigeria should be at a windfall. At a point in time, we had excess crude account in excess of $18 billion. But, that's not the case today. So we need to go into some debt restructuring, give ourselves some breathing room so that when the revenues begin to improve and come in, then we can have sustainability. So I think that's really what we need to address now to ensure that our debt profile has improved. Yes, the multilateral debts are there, they're long-term, they're there, but how much more can we do? Because we do not want to go into an IMF resolution, and we do not want an imposition by the Paris Club or the London Club. This is something we need to do ourselves based upon our cash flows so that our budget can be implemented, and within the next year, we can resolve our revenue issues, and then we can now put Nigeria on a track of sustainability. Because growing this economy is not very difficult. 2014 and 2016, the Nigerian economy grew in excess of 8%. Why? If you look at the historical data and the relationships between GDP growth, interest rates, and inflation, at that point in time, interest rates were like between 12 and 15%, and inflation was between 10 and 12%. The targeting of inflation that the central bank is doing is very, very important. If within the next 9 months we can get to those sort of revenues, we will be assured 8% economic growth. And that indeed is the silver bullet.
Yeah, indeed. And of course, the government has been targeting a $1 trillion economy. Quite a lot to unpack there, Reuters, from this discussion.
Indeed. I want to get to the central bank. The mandates of the central bank: price stability, low inflation, the exchange rate management. How do you think we can get there, considering where the numbers are? This whole theme seems to be vision and reality. So, how do you think the CBN gets there?
Well, let me piggyback on what Tilewa said around inflation. Inflation for Nigeria is not just demand pull, right? It's a blend of demand pull and cost push inflation. And so having sole dependency on the CBN to pull down the inflation rate is not ideal. There has to be proper collaboration with the fiscal side because of the cost push component of inflation, which in my opinion, if I was to draw a pie chart, the cost push would consume so much more than the demand pull. But that said, we do expect to see consistent monetary policy tightening to combat rising inflation. From my perspective, and at this point, because projections are usually revised, I would say there will be consecutive rate hikes in the first half of 2024 because the mandate is really that price stability. Now, with regards to exchange rates, for me, it's really a liquidity issue, right? Liquidity constraints still persist. And I know there are conversations that are going on to try to boost that liquidity. And once that is sorted, to a good extent, we should see that impact rates. There's still speculative demand that's driving the rates, particularly in the parallel market. Also, I would say that well, we did see news recently around some clearing of the existing backlog, and based on our calculations, when we do that estimate, it comes to 30% of the number that was disclosed, and so 70% still remains. When you look through the trend, and I'm referring to the NAFEM, the official window, you'd see that CBN did not inject into that window for a few months, since August actually of last year. So I'm not optimistic that we would see injections, at least in the first quarter of this year. So again, what I'm trying to say is that liquidity constraints will persist. Those are two indicators you mentioned for CBN.
Yeah.
What was the third?
Well, actually, we're running out of time, and thank you for the in-depth answer. But Tilewa, let's round up with you jumping in on exchange, because real quick, Chinwe mentioned the CBN trying to address backlogs. On the front page of today's This Day newspaper, Nigeria's newspaper of record, at the top of the masthead, as Mr. Finney likes to say, the CBN did say that they had paid about 61 million naira to the airlines. The airlines on today's newspaper, the headline today said that's not enough. 61 million, you're owing $800 million. So that's a drop in the bucket. What is, I have to have you chime in on the exchange rate. What do we do? Do we float it completely or what?
Well, you see, for me, like I said, this is a marathon, not a sprint. So the central bank really needs to move very quickly on two things. They have an inflation targeting program which they need to announce and begin to implement because the market is waiting. They also have a new foreign exchange management system which can no longer wait. So the central bank really needs to make announcements on these two very critical things, especially foreign exchange market, so that we can begin to see some stability in the market and its operations. Like I said, it's a marathon and it's not a sprint. The confidence I have in the economy is that we have an economic management team that is very sound. The Honorable Minister here is an ex-City banker. The Central Bank Governor is also an ex-City banker. The Coordinating Minister of Economy and Minister of Finance is an ex-Chase Manhattan, now JP Morgan banker. So we have a sound team and the expectations are very high. They understand the situation and they know what's going on. So the key for us is that they need to signal the markets properly to be able to restore confidence, and we need to see sincerity and commitment with the implementation. So we know where we're going, but people are getting impatient. So it's the signaling that is becoming important now.
Yeah, indeed. You say it's a marathon, not a sprint, but we have to sprint away from this discussion to talk about something really key. Thank you so much, Chinwe Eguin, Chief Economist at Coronation Merchant Bank, and Tilewa Adebajo, CEO of CFG Advisory. Now, there is one particular thing that this entire discussion hinges on, at least for now. oil. So stay with us, because right after the break, we'll be taking the discussion on Nigeria's energy sector outlook with 3 private sector experts. Thanks for joining us. Stay tuned. Well, welcome back to the Arise KPMG Budget Day 2024 discussions. You've been hearing a lot about the budget details, as well as a discussion with the Minister for Budget and Economic Planning. Now, we're going to be talking about something that is absolutely critical to Nigeria's economic goals in 2024. It is literally what runs through Nigeria's veins, from the hills of the Delta to the power plants to the Dangote refinery. The energy sector is a fundamental anchor for economic stability in Nigeria. And to help us get through this interesting discussion today, I've got 3 notable experts with me. First, we've got Mr. Ayo Salami, who's the head of the energy line of business at KPMG Nigeria. And of course, we have the founder and chairman of AA Holdings, Mr. Austin Avuru. And last but by no means least, we've got the group managing director of Sahara Power Group, Mr. Kola Adeshina. Welcome to the discussion, gentlemen. Great to be talking to you today.
Thank you.
So I'm going to start with you, Mr. Avuru. You know, you are on the front lines, the private sector, and you've seen the assumptions in the budget. We are looking at 1.78 million barrels a day in production and about $77 a barrel in terms of oil price assumptions. From a private sector perspective, are these realistic assumptions, given where Nigeria's production capacity is now and given global events?
These assumptions, fortunately, the Honorable Minister pointed out in his discussion that these assumptions are ambitious targets. And I think they were deliberately set to ginger the industry, to up their game, but otherwise they are clearly not realizable. Today, we are doing oil and unblended condensate at 1.46 million barrels per day. That's where we are today. That's 23% shortfall from this budget figure. Today, oil price is roughly where the budget figure is, $77, and fairly volatile within a 5% band. So it could be $74, it could be $80. So we've already maxed out in terms of oil price. In terms of production figure, we are 23% short. And when you build in a 10 to 12% natural decline year on year, it means you are looking for a 40% increase in production to get to 1.78. But even more than that, to get to an average of 1.78 during 2024, you are looking to exit 2024 at about 2.2 million barrels. Clearly not realizable, because I'm not seeing a work program in the industry today that suggests that these numbers can be realized. However, as I pointed out in the beginning, these ambitious targets were deliberately set so that those who run the industry, we know what's ahead of them and what they need to do to meet those targets.
Yeah, it certainly puts the key stakeholders under pressure. 40% increase in production. Our run rate needs to increase from the start of the year.
Yeah.
I'm going to come to you, Mr. Salami. Anchored on what Mr. Avuru has said, it's been 2 years now since the Petroleum Industry Act. I think 2021 was when it was passed. I want to ask about what some of the loose ends are. What are the soundings are you getting from the industry about whether the impact of that act is being realized in a tangible way within the sector?
Thank you very much, Mulake. Good afternoon, viewers. I think the important thing to say is that several years ago, we were under a situation where there was no clarity as to the physicals that govern the oil and gas industry. Luckily for us, 3 years ago, we got the PIA. Not a perfect law, but I can tell you there are so many issues that have been talked out about that law. The first and very significant one is around the physicals around gas. The government has declared this decade as decade of gas, and what we expected, right, in industry was a policy or a law that supports that in its entirety. But unfortunately, I must say, if you look at the PIA itself, the physicals around gas seems not to support that ambition. And how do I mean? Prior to PIA, we have a situation where gas operations were taxed at probably 30%, right? With PIA, there's a selective treatment. What I mean, natural gas liquid, for instance, produced in the associated gas fields, upstream of the measurement points, are now going to be taxed at a higher tax rate. That, in my view, does not support that agenda of declaring this decade as a decade of gas and using gas as a transition fuel for the economy. Still on gas, if you look at the starting sections of the PIA, there are themes that suggest that it's going to be a regulated industry, right? You can't have a regulated industry where you're trying to see that industry is safe. It's a lever of our growth or for transitioning to greener energy. So if gas prices are regulated, either at the upstream level or at the downstream level, that does not seem to support investment in that sector. Because clearly, dollars will go into environment or products or projects that can deliver the right returns. So those are key around gas incentives. Of course, the other angle to it also is to say that prior to now, we've talked about trying to advise the government on selling down NNPC's interest in JV assets. And the convention was around trying to do that very quickly. But with PIA, I think that has, in a sense, shifted slightly to, look, let us do IJV structure, which in a sense puts us in a kind of environment like LLNG where government does not have to do cash calls because the money is not just there. Again, it's something that's in the PIA, but it's yet to take effective root in terms of implementation. I will know there are a couple of assets that have been translated to IJV, but the real assets are yet to be done. So that's also an area. And of course, the other bit is around IPO for NNPC Limited, which one should expect ordinarily should have happened. Right, because we want is a national oil company that is comparable in terms of operation, size, and access to capital like Saudi Aramco of this world. That hasn't happened. So those are the loose ends. Right? I'm happy that in this year's budget, government has a plan to revisit the IPA, and there's a budget for about 200 million naira in the budget for the Minister of Petroleum Resources to see to the review of PIA. So I expect that some of these loose ends will be tidying up.
Indeed, we certainly expect some further steps to be taken on the PIA, but you talk so much about gas, and of course that is a key feedstock for our power sector. If you look at the last 10 years since the privatization of the power sector, can you categorically say, Mr. Adeshina of Sahara Power Group, that we've achieved our goals insofar as the power sector is concerned, and then what can we expect in 2024?
Okay, thank you. Good afternoon. Last 10 years, I think it's been very turbulent, most especially for those of us that invested in the sector. And this is born primarily out of the fact that the tariff, which is the price, that's the engine, that's the oxygen of our sector, is not right. So the cost is higher than the current price, and it's been like that in the last 10 years. If you want to stimulate investment, naturally, one of the conditions would be for you to have a right price. So, which is why it's been a big of a problem for us to attract additional investment. For some of us who already we've committed over $1 billion into this, we want to do more. But today, the price is just not right. Our business is a model business, modeled around the critical elements of inflation rate, interest rate, and foreign exchange rate. Of course, the model, as against the reality, there is a great disparity, a major variance. And of course, that is a disincentive for any one of us to really inject additional money. Now, something is happening which I need us to consider as well. Every day in Nigeria, new births recorded is 24,329. Every day. Invariably, you have 8 million year on year. That is coming
in terms of population.
In terms of population. So the infrastructure is lagging behind. The investment is not there to cater to this population. So we have a major problem. And that's why you see that in giving out electricity, what we've done now is to segment the market to those who can afford to pay the right price and let them cross-subsidize for those who can't pay. As we sit here today, we were meant to get a tariff review 1st of January. Well, we've not gotten it. We're still waiting. And it's because government is sympathetic to the man on the street, but the business is suffering because we're the ones subsidizing the sector. The investor shouldn't subsidize. It's meant to be government subsidizing or the customer paying the right price. Today, we are not charging the right price.
Yeah, and in fact, the market segmentation has been sort of a stopgap measure to your ideal scenario, which is a fully liberalized market, at least downstream. You know, we often talk about the fact, Mr. Avuru, that gas is a regional market, and there have been many projects announced over the years of Nigeria exporting gas to other countries. From where you sit, what is the real challenge, apart from tariffs, which are key, to attracting investment in Nigeria's gas sector? And what are some of the additional things we can do to boost our productivity in gas?
The gas business is an end-to-end business. Crude oil, once you produce crude oil and put it at the terminal,
You're going out.
You get the dollars. Gas, you have to first worry about the consumer, the off-taker, before you even start producing it. Now, we had a projection from 2012 to 2017 to increase domestic gas production from about 700 million square feet a day then to about 2.5 BCF a day. We did that up to 1.1, 1.2 BCF a day, and we have stalled for the past 6 years. The main reason is the power sector that was projected to take 70% of that increase has also stalled at 4 to 5 gigawatts. And so once the demand end stalls, we can put in more investments. I can tell you, in 2015, when I was running Seplat, I had a list of about 11 potential power companies begging for gas, and we're going to increase our gas production. Seplat has just finished, mechanically completed the 300 million square annual gas project. As we speak today, there is not a single potential power company that is looking for gas, that is knocking on the doors for gas. And probably other than Seplat, there is not a single upstream company that is investing today in additional gas production. So once you break any part of that chain, particularly from the consumer side, then you can get started. But I must say that other than power, you have the fertilizer industry. You have petrochemicals that hopefully we start with the Dangote refinery second stage. We have industries, a number of industries, and now a new addition to the demand will be CNG for trucks and buses. I expect that to ramp up quite rapidly over the next 3 to 4 years. I mean, in India, 70% of their trucks run on CNG. CNG is 35 to 45% the cost of diesel. So if you manage to convert your truck to CNG, over a 2-year period, you start seeing the gain. So I expect that kind of increase. So overall, no matter what we do, gas has to become the enabler for economic growth. It just has to be.
In fact, the enabler for industrialization on a large scale. And, you know, it's always been interesting when you anchor the gas sector on almost one sector, the power sector. But let's scoot over to another issue. You know, we're talking about the global energy transition, and now more and more companies are talking about hybrid projects that combine solar energy sources with alternative energy and gas, which is still important for baseload electricity. Can you tell us a bit about renewable energy's potential in Nigeria in 2024 and beyond, Mr. Salami?
Thank you very much, Rolake. In terms of renewable energy, we can look at it from the perspective of regulation or regulator, and then the operators as well. From the perspective of the regulation or regulators, you observe that about 9 years ago, I think it was 2015, the Energy Commission of Nigeria actually rolled out the Renewable Energy Master Plan for the country. Under that plan, we're supposed to, by 2025, which is next year, achieve a renewable energy contribution of 10% compared to total Nigerian energy consumption, right? This is just 1 year to that sunset date. What have we achieved? Where are we on that journey? Have we diligently pursued that ambition? I can answer that question. Again, I'm not sure that anybody from ECN is here to attempt to answer that question. But clearly, we need to find out what has happened. Beyond that is also to see that for the regulator as well, and in fact, sometimes I ask, what does the budget provision make for this? This year, there's a provision for about 100 million naira, right, in the budget of Ministry of Petroleum Resources to study the competitive advantages of using CNG, LPG, and the rest as transition fuel for consumption. That's very good. But beyond that, we need to know what is happening to our renewable energy master plan in the context of the bigger energy transition. That's number one. From the auditor's perspective, these projects are very capital intensive, requires a huge amount of money. And like I said later on, money goes to where the returns come from.
Yes.
So investors will not put in their money if they are not sure of returns on their investment. Now, in the last 2-3 years, we've seen some uplift or some buzz around that. Last year, we saw the projects being championed by Naseni in conjunction with the China Great Wall Incorporated, which is one of the biggest West African solar panel production plant in West Africa, being inaugurated in Nasarawa State. We're looking at about $170 million. It's going to be a partnership between those two entities. Mostly, they're going to provide the seed funding by China African Investment Fund. The other one that we also saw last year was the Oxano 110 megawatt PV solar panel production plant. These are good strides, but again, because of the massive investment that is needed, government needs to come in, either in terms of incentives, to support private sector capital into that sector. Thank you.
Yeah, thank you very much. And you make some very interesting submissions there on projects that are partnerships between some foreign companies and local entities. And I want to ask you, Mr. Adeshina, you oversee a group that includes, the downstream utility, the discos and others. Is there space for some of these traditional incumbent power players to venture into the alternative energy sector? And what, from a policy or regulatory perspective, needs to happen for that to be a reality?
I love the posture of the new administration, most especially if you look at the budget. You will realize that for Ministry of Power, 344 billion was earmarked in the budget, and of that, 127 billion was earmarked for renewable energy. Invariably, it shows that, yes, government is really keen in seeing an uplift in that regard. And it is even more interesting to note that of the 127 billion, 123 billion is for capex.
Okay.
One of the things one would want to consistently see generally in the budget is that the capex should be more than the recurrent. That way, truly, you can push the economy and achieve the GDP of 1 trillion that we're looking for. So from a policy perspective, from the budgetary perspective, that's something we love. As an organization, yes and yes and yes. Why? Because of the fact that we belong to a world we don't want to destroy. We're part of a human community that we must nurture one way or the other. So part of what we're doing is that we're involved in climate adaptation for our assets as we speak today, and we're equally putting money into solar and wind going forward. However, I need to state this, and this is really a bit controversial. Nigeria has gas. I think we need to spend more time ensuring that our gas to power brings us better energy than the renewable. Renewable is okay, but if you want a big economy that we urgently desire to see, with the growing population, it is only through industrialization via big energy.
Yeah.
There should be a conversation in the country around comparative advantage of having gas and using it to create employment, industries, and the rest of them. I would want to see industrial clusters grow in a very big way, methodical, well-planned, and yet still injecting renewable energy into the space, such that when the grid is not available, at least you can switch to solar and other methods of generating power.
Yeah, indeed. What we need is a balance and a diversified energy mix. Mr. Avura, I'm going to come to you for the last word on this panel. There's so many moving parts in our energy industry. On the one hand, we're seeing the advent of the Dangote oil refinery, which could transform the face of the downstream oil and gas sector. On the other hand, many companies in your space are moving towards decarbonization. So I guess, what is your projection for Nigeria's actual energy strategy and how both private sector players should fit in that to ensure that we get this diversity in our energy sources and mix? And what do you hope will happen over the next couple of years as we transition fully to a more climate-friendly world?
First, it's reassuring that we're finally getting private sector investment and, in fact, dominance in the downstream. The refining sector has been constrained for the past 20 years because it was a government monopoly. With Dangote and Bua, hopefully over the next 12 months, we'll find a refining capacity of close to 900,000 barrels per day, at which point it will not matter to any Nigerian which refinery is working or not working, once the capacity is there. Just the same way as we didn't quite remember that there was NITEL once the other telecoms companies were operating well. So that constraint will be removed in the downstream. That's in the refining sector. In the upstream, we need to remove the obstacles to investment in the upstream. There has been such a huge constraint in investments in the upstream, from a high of $25 billion a year in 2011-2012 to $5 billion a year on the average over the past 3 years.
In terms of investment.
In terms of investment. And that's really the reason for the production that has gone from 2.2 million barrels to 1.3. Really, that's the summary. We need to reverse that investment trend in the upstream, and it's the private sector that can do it. So government's position through NUPRC, and that's one of the key elements of the PIA. The PIA has really, really empowered the regulator to drive the industry, to drive the upstream. The same way as the central bank drives the financial sector. That's the way the NUPRC, that's where the real issue is. NUPRC has to be target driven. If we want to do 2 million barrels a day, what are the key elements? What is the work program to support that kind of ambition? It's NUPRC, no one else. So government should move through the regulator to ensure that our targets are met by realistic work programs and capital injection from the private sector. The private sector is ready once the industry is enabling. That's what we're looking for.
And all this while decarbonizing and reducing our carbon footprint.
Yes. So first of all, decarbonizing, we decarbonize even in our activities in the oil and gas sector. And then in addition, we manage a transition that optimizes the use of our resources as a nation. So I usually have a chart that shows we should be optimizing our crude oil production over the next 15 years and get the most revenue out of it. And then optimize our gas production for a 20-year plateau, okay? Especially domestic gas production, to fire our industries. And all of this will then generate the revenue that you require to invest in renewables. So it has to be a well-articulated journey. It can't be.
Indeed.
Right now, we're not doing exactly that.
That also highlights why gas is really the transition to a more cleaner future. It's been such a fantastic discussion. Mr. Austin Avuru, Mr. Kola Adeshina, and Mr. Ayo Salami. Well, you've been hearing this expert panel talk about the energy sector outlook and what to expect in 2024. There's still a lot more here on the KPMG Arise Budget Day 2024. And now to take over the discussion going forward, I'm going to scoot over to my colleague, Boisson Omofaye, to lead you on. Thank you.
You're still watching Arise KPMG Budget Day 2024. I am Bosun Omofaye. Now let's keep the conversation going and try to put some food on your table. We're discussing agriculture and food security. 200 million mouths to feed every day, 365 days a year. In other words, if you have a square meal, 3 square meal, we need to make at least 600 million meals every day. And that's a whole lot of work. The country has a budget for agriculture this year, 362 billion naira. Would that be enough for all of us and the new ones we're breeding? Now let me bring into the conversation Ndidi Oneli Okonkwo, who is on the board of several board companies in Nigeria. Of course, we talk about companies within the food and agriculture chain. She is also the co-founder and the chairperson of this organization that has a whole lot in agriculture and nutrition. Thank you so much for coming, Sahel Consulting. It's good to have you once again. It's good to have this conversation with you once again. And you're so passionate about food and agriculture. And I'm enthused by your zeal for how to see how Nigeria can go on a food sustainability. So, well, 362 billion naira in budget allocation this year for food. And do you think we should ask the Honorable Minister who's in charge of budget and economic plan that is here if we need more money? And he could just approve it for us. He's just sitting here in the audience. If that's not enough for you.
Well, I have to say that it's a very small amount relative to the issues that we face in the country. And it's not about food security alone, it's about nutrition security. Because food is medicine. So when we talk about the food ecosystem, it touches the Ministry of Health, the Ministry of Trade and Investments, the Ministry of Youth Development, Education. It's cross-cutting. And Nigeria committed to the Malabo Declaration in 2014, which is a commitment of 10% of resources to agriculture and food systems. Our current budget is 1.2%. And with the food insecurity facing our nation and the over 30% food inflation in the country, the average Nigerian cannot afford a healthy meal. The last statistic actually showed that only 84% of our population cannot afford a healthy meal. So the average Nigerian is struggling, is hungry and angry. And when you have that in a population, it affects productivity levels, education output, human capacity, and obviously all our prospects for growth are limited if we do not nourish our people. So from where I'm sitting, the amount we have allocated is too little to get the work done. And unfortunately, we're still looking at this food ecosystem in silos as opposed to looking at it holistically to drive economic growth.
Interesting. Do you think we can use what we have to get what we want? 362 billion naira. And then, as I said earlier, we're going to ask the minister to tell Mr. President to give us additional fund moving forward. But again, how do we use what we have in the current year budget, fiscal appropriations, to improve on critical areas that we need to develop? About 102 billion naira of this goes to National Agriculture Development Fund, which is also help us to develop the various areas of agriculture sector, the entire value chain, infrastructure. You need investment in storage, productivity, distribution network, the whole 9 years, in the manner of speaking. Do you think we can make something good out of what we have?
Well, given the limited funds, we're going to have to prioritize.
Good.
And I would say that historically, we've not done a great job of prioritizing which value chains are most important. Now, I would say there are 6 value chains. Maize, soya, because of poultry and animal feed, cassava, yam and rice, and then dairy, poultry, and tomatoes. We have to remove the bottlenecks in these value chains. We have to triple productivity. We have to reduce post-harvest losses, and we have to enable the private sector working in these sectors to thrive. And that means that we're going to have to cut out a lot of the waste in our ecosystem, and we're also going to have to remove a lot of the bottlenecks around how we deploy resources. We're going to need the Ministry of Finance and the Central Bank to hold financial institutions accountable to give financing to the private sector working in agriculture. We're going to have to create incentives for new investments in that sector. We're going to have to address the insecurity in our ag sector so that our farmers are safe and they can work. So I would like to suggest really a presidential ecosystem task force. And I think the other question was posed to the minister, how do we have a seamless commitment to this sector where we have ministers in charge of all the key components of the ecosystem held accountable to deliver for Nigerians so that we can actually have food on our table that's affordable, available, accessible, and healthy.
Interesting. In terms of, if you look at exchange rates, for example, and what we would try to budget for our agriculture sector this year, and then you look at how affordable food prices will be when you look at exchange rates keep moving around, and then we're trying to hold it down somewhat in the manner of speaking without offending the market, allow the market forces to work. So 800 naira to the dollar. How do you think we can impact agriculture this year with the kind of exchange rate volatility that we have on our hand at the moment?
Well, the first step is ensure food self-sufficiency. Nigeria can feed Nigeria, but we need to grow our output. We have to reduce post-harvest losses. Now, for the value chains I've mentioned, we're naturally endowed to grow them, and we can. So if we become food self-sufficient, we're not going to be dependent on imports, right? Instead, we can actually export ginger, sesame, the products that we don't need to eat on a daily basis. And so I think the prioritization has to be clear. Food self-sufficiency and then export-led growth. How exchange rate affects the agriculture sector now is that food is so cheap in Nigeria for the external world that we see truckloads of Chinese traders from Niger coming to our farms and buying and taking it out of the country because to them it's cheap. To us, it's expensive. And so what we have to do is protect our economy, protect some of our borders, so that if there's going to be exports, it's through formal channels so that we can get the returns and the forex. Yeah. But when we continue to see the porous borders that foster illegal trade of our food products, we see this in sesame, in millets, ginger, and sorghum. And this is really heating up the market. So already, prices have tripled when we should be seeing low prices because of recent harvests. So we have so much work to do from a policy perspective to enable the food ecosystem to thrive. But this is one sector we're naturally endowed for, and there's no reason why Nigeria is not feeding itself and feeding the rest of Africa.
So, I'm going to go back to that figure. 857 billion naira is what is on the table for food and security put together. So you see food security as a national security issue? It
is definitely a national security issue. And unfortunately, we haven't seen the seamless collaboration between our national security agencies and our ag investments. There are a few steps we need to take. One, every single security agency needs an agriculture desk. At the recent Sahel Food Changemakers Conference, where the Honorable Minister joined us, we talked about the need to have agric desks at every single security agency. And every single agric agency needs to have a security desk. We need our security organizations and apparatus in our country working with our farmer organizations for intelligence. We need to actually invest to enable these farmer organizations to police their own communities. There's so much investment we need to make to address the insecurity challenges in our country. And if we don't address them, coupled with climate change, we'll continue to struggle in this sector.
And I was about to ask that if we're putting enough cash on the table for climate change and climate adaptation issues that we have to deal with. Again, when you look at across Africa last year and years before, you've seen a whole lot more. In Nigeria, for example, flooding that we saw in 2012, we saw this in 2022, 23 as well. Again, this will have major impact, breaking down roads, washing away thousands of hectares of farmlands and running businesses and farmers into losses. Some of them are yet to recover, and some of government interventions going down the drain because of climate issues. So how much more of what we have on the table do you think we can do? Can we source external support to support our farmers and support the various state governments and other private sector institutions to mitigate this climate adaptation? We need insurance in that sector as well.
Definitely, you've laid it out. We have great research institutions that are indigenous in Nigeria producing drought-resistant seed, flood-resistant seeds, productivity improvements, and unfortunately they're not getting into the hands of the farmers. And that's because of our weak extension systems. So we really need to enable our extension workers to have the technology to teach farmers how to adapt and mitigate given the climate realities. We also need to empower states. At the end of the day, agriculture is deployed at the state level. And our states are not ready for the droughts, the floods, and they have not put in place systems and structures to preempt some of the damages that we have.
Various Ministry of Agriculture
at the state level,
the state and subnational
and really level. Enabling the government. Now, there's so much climate financing in the global arena. How are we positioning Nigeria to receive that climate financing and enabling our private sector institutions to take advantage of the climate financing and allocating it to local organizations? Finally, we really need to have a more cohesive look at what it will take to reduce post-harvest losses. Because climate change, the heating up of our economy, not just droughts and floods, but increased heat, where there is no storage, no cold chain. Our markets are still archaic. We're still using raffia baskets in the 21st century. So 40 to 60% of our fruits and vegetables go to waste, 20 to 30% of our grains. Unless we invest in new technology, primary processing at the farm gate, but processing in our food companies, we're going to see hunger persist in the land.
When we discuss agriculture and food security, do you think we need to move very rapidly to agro-allied part of this conversation, in which some steps being taken, some support that Nigeria is getting, for example, from the AFDB group, the African Development Bank, doing about 22 states for special economic processing zones? Do you think that is one help that we need to work on very quickly to ensure that we can move on, reduce post-harvest losses, and get to do more cottage industries along the corridor of our agri-value chain?
Definitely, and that's why we need an enabling environment for private sectors to thrive. Most food companies in Nigeria are on their knees because of the power issues we've discussed, the security issues, the purchasing power challenges. Most of the companies we work with through African Food Changemakers and Sahel Consulting are considering closing down. And that's not what we need right now. We need Nigerian companies thriving and actually filling the gaps that the high, expensive imports have created. So we need an enabling policy environment. Financing, we need to remove the bottlenecks. I know we talk about tax regimes, but we need to have tax incentives for people to invest in agro-processing in this country, and we need to have technology transfer. Unfortunately, we have done very little processing in Nigeria. Most of our companies import pre-processed products and repackage them. But we need to give incentives to companies that are sourcing from our farmers, processing for the Nigerian market, and producing nutritious food that's affordable.
Small and medium enterprises companies.
Small and medium-sized enterprises need to be at the forefront of our development agenda, and I haven't seen that type of commitment yet. And I would really like to encourage this current administration to put its money where its mouth is and invest in local food processing for Nigeria and eventually for the world.
Interesting. I wish I could just give you a handshake. But it's just a little bit of a divide here. Ndidi, thank you so much for speaking with us. We appreciate that from Sahel Agriculture and Nutrition. Thank you so much. And your passion for food, nutrition, and agriculture in Nigeria will on board quite a lot from what you discussed with us here at the Arise KPMG budget today. Thank you so much, and we'll enjoy the rest of the year. Now let's talk more about tax reforms. Again, she just talked about that earlier, but we'll have a whole lot more coming through here from the KPMG headquarters for Nigeria and West Africa. This is Arise KPMG Budget Day 2024. We'll be right back, everyone. Stand by.
Thank you very much, Bosun, for that introduction. We have here with me Thank you very much, Ajibola, for that introduction. So I'm here with Ajibola Olomola. He's a tax partner in KPMG Nigeria. He heads the media, telecoms, and technology sector of KPMG Nigeria. My name is Elizabeth Olahere. I'm a tax partner in KPMG focused on consumer markets. We're going to be talking to you today about tax policy, and we're going to talk within the confines of the 2024 budget and also what businesses need to look out for with the tax budget. So Ajibola, we've been here and we've heard a lot about the budget, the synopsis. The Honorable Minister of Budget and Economic Planning has helped with a lot of the explanations. We've also heard a lot of our speakers talk on the energy sector. Now, we need to talk about revenue. One of the key strategies for helping with debt financing is increasing our revenue and our tax to GDP ratio. It's now a matter of public record that Nigeria has one of the lowest tax to GDP records in the world. And the government is very aware of it. There's a heightened need to increase this tax to GDP ratio from a current 10.86 to 18%. So Ajibola, let's talk about how the government wants to expand the tax net, increase the tax revenue to help with potentially funding the huge deficit we have in the 2024 budget. Over to you, Ajibola.
Thank you, Lizzie, and thanks for having me. It's a very important question you've asked, and when the minister opened the session earlier today, he did allude to the ambitions of the government in terms of raising revenue, and Austin Avuru also put a twist on it by saying that the government has targets for themselves in the hope that that would galvanize action. You know, like a good friend of mine once said, if you dream and your dream allows you to sleep through the night, then you've dreamed the wrong dream. Your dream should wake you up and get you going. And so the president, by setting an agenda to raise the tax to GDP ratio to 18% from 10%, which it is today, is essentially signaling that things are not going to be as they used to be. And they've said they want to do this within the context also of not introducing new taxes.
Correct.
So this is all about widening the tax net, closing gaps, bringing more revenue streams on board than previously were the case, without necessarily increasing the tax burden on the average taxpayer in Nigeria. And that's definitely the way to travel.
Exactly, Jibola. You've mentioned valid points. Increasing the tax nets, bringing the informal sector into the tax nets. We've heard a lot of conversations from the FIRS chairman and even the Minister of Finance say that there's no intention to increase tax rates. There's even potential of compressing most of our taxes because we have significant multiple taxation problem in Nigeria. So one of the key things that the government is looking at is to bring in the informal sector into the tax net, thereby widening that tax net. As a matter of fact, the IMF has looked at a study in 2017 and posits that 65% of the informal sector contributes to our GDP. So once we're able to get that informal sector into the tax net, it will form a basis for really expanding the revenue that we can get from the tax net. Let's talk about technology and how we can widen our tax net with technology.
Well, yes, and you've situated the conversation appropriately by referencing in harnessing the informal sector.
Absolutely.
And the contribution they can make to the economy. One of the easiest ways to do that is by use of technology. Technology enables you to track revenue in a more comprehensive manner and to also eliminate gaps.
Right.
And of course, by closing gaps, you then encourage people to inculcate a tax-paying habit. And we've seen the tax authorities in Nigeria introduce and leverage technology for the for performing of their duty of tax collection. So at the federal level, for instance, the Federal Revenue Service introduced technology, ProMax, which is what is now being used by taxpayers across the country to remedy their tax filings. And it's been an effective tool. And we've seen the tax yield increase dramatically in Nigeria from 3.5 trillion to 5 trillion. Yeah. And then a leapfrog.
10 trillion
Absolutely.
In 2022. It was the highest in recorded history.
And it is projected that because as of June 2023, FRS had raised 5.5 trillion Correct. In taxes, and it is projected that by December 2023, the FRS would achieve potentially 12 trillion in taxes. So we can see that use of technology has unlocked potential economy and enabled us raise our tax to GDP ratio from a measly 6% of GDP. It's now about 10.1% of GDP. Of course, there's still some way to go to get to 18% that the president has promised, but 18% itself is not overly ambitious if you think about it, because the average in OECD countries is about 34% of GDP. And the average in Africa is about 15% of
Correct.
GDP. So 18% will take us to the Africa average, but there will still be room to grow into the potential average that we can see in other places like South Africa and the OECD that are in excess of 30%. But it's still the right direction of travel.
Great, Ajibola. It's clear that we're moving in the right direction as a country. There's a lot of debate about how ambitious the budget is and seeing how we're increasing our revenue. For instance, tax is supposed to generate an additional 47%. The question now is, if the government is not trying to increase the rate and we're looking at the informal sector, are there practical things that the government is doing right now to really help harness the informal sector? For instance, the president inaugurated a committee on fiscal policy and tax reforms, and they've submitted something called the Quick Wins Report. And it's clear from there that they want to really harness the informal sector. There's already implementation of the Market Traders Association of Nigeria, where there's about 40 million members of the informal sector. Can you talk a bit more about how this would help really widen that tax net?
it's commendable what the President and the President's Committee on Fiscal Policy Reform and Tax Reform are doing, and credit to them. And you've highlighted one of the quick wins that have been identified, going into a memorandum of understanding with the Markets Women Association across Nigeria, 40 million members, like you said. That's bringing into the tax net 40 million taxpayers that previously were not necessarily fully tax compliant. Now, most of these market women will be paying taxes at the state government level. So you might say that that does not necessarily increase federal tax revenue. But by putting more money in the hands of the state governments, you reduce the necessity for the federal government to intervene by giving states subventions and grants. So it's the way to go. So it also begins to inculcate tax paying as a habit in most Nigerians. By the time you have hundreds of millions of Nigerians who know that they want to discharge their tax responsibility, you narrow, potentially eliminating the scope for tax avoidance and tax evasion. But I'll then go on to say that obviously 40 million is not the total population of Nigeria. That in itself tells us that we need to migrate from the era of using blunt tax strategies into using smart tax ideas. Ideas, for example, of disassembling the entire economy into bite size and attacking sections of it in a bid to improving compliance rates and closing gaps. What that then means also is that you can disaggregate even further and begin to look at sections of the economy where there's a higher tolerance of tax. For example, so people have talked about luxury tax, but it doesn't really need necessarily be a luxury tax. It could just be a recognition of the fact that Nigeria's VAT rate, for example, is one of the lowest across Africa at 7.5%. Now, obviously, if you were to increase that to 15, 20%, that would be a real high burden on the average Nigerian. But there are ways of disaggregating the VAT economy such that you apply a higher rate on more luxury items. For example, if you are flying, let's take an airline ticket, for example. If you are flying first class, you should be able to pay VAT at a higher rate than 7.5%. But if you are flying economy, perhaps you can pay at the base rate. Now, you can start making those smart adjustments without necessarily introducing new taxes. Another thing you can do, which some agencies like the NIPC, the Investment Protection Promotion Agency, are already doing, is to begin to engage investors when they invest in Nigeria to say to them, what incentives do you need in order to establish your investment in Nigeria? And then interrogate those incentives and give only those particular incentives that motivate a particular business, and also requiring the business to tell them what they're going to produce in Nigeria, what the cost benefit to Nigeria is. The multiplier effect of giving that incentive. By beginning to move in that direction, our tax strategy begins to be smart and not blunt. Imagine if, when you are asking me for a customs duty waiver as Nigeria asks of you, what is the multiplier effect to us if we give you this duty waiver? What's the increase in employment? What is the contribution to GDP? What is the foreign exchange implications? And so we engage with you and we require you to give us a KPI, an MOU, setting out what you're going to achieve, which we can then begin to measure as a condition for giving you a tax waiver.
Great, Ajibola. So that takes me to a very valid question I wanted to ask. It's about the paradox of tax incentives. So, in the one hand, you have tax expenditure coming from tax incentives because you're losing out short-term on revenue that you could have collected as taxes. But on the other hand, you're creating an enabling environment for companies to prosper and generate more revenue that you can subsequently tax. So Nigeria, obviously, through the Nigerian Investment Promotion Commission, administers the Pioneer Status Incentive Tax Holiday. And they've been doing a lot of tax impact assessment on what they deem as the benefits of giving this pioneer status to beneficiaries. So some of the things they've tried to do is something called an annual performance report, where companies are supposed to submit on an annual basis the basis of the pioneer status and what they've done with the pioneer status. In addition to that, when a company wants to get an extension, they are supposed to demonstrate the value they've added. And you've mentioned some of those key parameters like employment generation, training for Nigerians, host community development. So the question is, at this time when Nigeria is struggling with a revenue problem, should the government be giving tax incentives, or should the government focus on establishing the basis of the benefit of these tax incentives before proceeding with the tax incentives?
Well, it's a very important question, and one in which the jury is still out as to what the best strategy is or should be. But it is one where the debate will have to continue. Obviously, some investor groups will look to you for incentives to come invest in your country. And when they compare the cost of investment in Nigeria with the cost, for instance, of going to neighboring countries in Africa, who also have large markets, Angola, South Africa, Ghana, next door to us, or North Africa, they're going to say to you, if I were to put this investment, say a gas plant, if I were to put this in Morocco, this is likely going to be my cost profile and my return on investment compared to when I come to Nigeria. So incentives can help motivate the final investment decision of an investor in choosing Nigeria over another country where they can take their investment to. So there's always going to be a case for incentives. But we've got to test in every instance to make sure that that case is established. So we're not giving away more than we ought as a country, and we're beginning to hold investors accountable to the promises that they make to us when they come into the country.
Great, Ajibola. Thank you so much for this fireside chat. I've had Ajibola Olomola here giving us a breakdown of potential tax policy reforms against the backdrop of the 2024 budget. There's a lot to look forward to. The tax landscape is vibrant, it's going to be dynamic, it's going to play a critical role in the implementation of the 2024 budget. We will continue to keep watch on this space, and we'll look forward to having you on the KPMG Next Tax Chat. Thank you.
Welcome back to Arise News. It is, of course, the 2024 Budget Day brought to you by Arise TV and KPMG. And this is our Eye on Tech segment. If you watch Arise News regularly, you know that Eye on Tech is every Friday on the Global Business Report on Arise News, 11 a.m. West African time. I'm sorry to show my bias, but this might be my favorite segment that we're about to get into for today. Technology and digitization sector. I am happy to be joined by two gentlemen from the awesome KPMG team. Lawrence Amadi, who of course is a partner, Tech Assurance and Digital Finance KPMG in Nigeria, and Ladi Asuni, who is a partner and Head Analytics and Operations Advisory. Gentlemen, thank you so much for joining us.
Thank you, Rotas.
Let's get into it. As we speak, right now in Las Vegas, Nevada, the Consumer Electronics Show is going on. There are all types of displays of new technology, window panes that are televisions, flying cars, and so on and so forth. So, but bringing it here to Nigeria, let's get grounded. I want to ask you both, starting with you, Lawrence, what are your thoughts on how this budget is able to advance the penetration of technology and digitization in Nigeria?
Rotos, thank you very much. I think the first point I want to make is there's a slight reduction in the number from 2023 to 2024, and it's about 40% reduction. What are the key areas or key segments in this ministry? First, we have to talk about the NCC. There's the NIMC. There's the Nigerian Communications Satellite, NIGCOMSAT. There's a NIPOST, just to mention a few critical agencies within the Ministry of Communication. Now, how important will this be? It's not a good time to talk about a reduction when you're thinking about how do we then propel what we call the digital economy. Now, we all know that the digital economy splits into e-commerce infrastructure, and then there's e-business. The telcos are all in here. They need approximately $3 billion to upgrade the network every year. So you've got to pay attention to how do we start scaling, this segment and ensuring that we have the right private sector-led mindset to run in this budget for the country.
$3 billion is, if you use the exchange rates, the equivalent of what's been allocated to defense, which is the highest allocation in the budget. So it tells you where we are and where we need to be. Ladi, let me come to you. What are your clients saying? KPMG, you guys, you're international, you're multinational, you got a lot of clients. What are they telling you about what they expect from tech from this budget and this government?
All right, thank you very much, Rotus. When we talk to our clients, there are three major areas of concern when you think about the situation with our clients today. Number one is the situation with IT skills. Right? We all know with the mass immigration of talent from Nigeria, technology sector has been one of the most targeted in terms of remote work opportunities, outright immigration to countries where opportunities are great. So technology talent has really impacted our clients across sectors, whether you're talking about banking, telecoms, manufacturing and the like. So technology talent is great. Our clients are interested in knowing what initiatives the ministry has in place to enhance availability of talent. Of course, the minister, as of November last year, launched the 3 million technical talent program, which is expected to build skills across 3 million Nigerians over the next 4 years thereabout by 2027, and they started with the prototype, program, which has managed to get interest from over 1 million Nigerians, 30,000 of which have been enrolled. So it will be good to see how this connects back to the technology talent shortage. A lot of the minister's publications have really been around how to get these people integrated back into the private sector, expose them to opportunities even in international markets where Nigeria begins to position as a net exporter of talent. So that's an area of concern. The second area I'd like to talk about will be around the high technology spend. Enterprise technology in Nigeria today, outside of personnel costs, the most significant spend relates to technology solutions that are imported. So whether you're talking about your ERP systems, your enterprise resource planning systems, your financial management system, procurement systems, HR system, customer relationship management systems, a significant part of the solutions in this space are mainly imported technology, which puts significant strain on our clients' IT spend, puts a significant strain on the FX. So the question is, how do the initiatives, especially as we develop talent, how do we begin to channel this into strengthening the local technology capability? How do we start developing technology solutions made in Nigeria for Nigeria? The public sector is a huge employer of labor, is a huge part of the market, and can begin to think about initiatives to, invest and promote development of locally developed technology solutions. And the third aspect of it I would like to talk about has to do with, cloud. When you talk about cloud technologies with our clients today, the major concern is usually around issues of data sovereignty, data residency. And cloud technology has been on, for so many years, but it's still interesting to see, as of today, the only data center in Africa, as we have it, is in South Africa. With the amount of business going on in Nigeria, I think there's a huge opportunity for the government, the ministry, to work and incentivize these technology players to begin to think about how we establish local data centers so that our corporates, can accelerate their journey to cloud adoption, can lower their IT running cost, and we can generally spur greater innovation without necessarily compromising our data sovereignty, as the case may be.
Awesome. Technical skills, imports, and cloud, right? Definitely. So perfect, Ladi. Lawrence, let me come back to you. Using that as a launch pad now, let's come to the minister has a lot of plans, and I was hoping was going to be here today, but hey, this 3 million thing, and then now he has another plan where he says we should accelerate prosperity, and by the way, just for our viewers, that's Dr. Bosun Tijani, who is the Minister of ICT. Accelerate prosperity through technical efficiency. And he's got a number of key themes. He's got knowledge, he's got policy, he's got infrastructure, he's got innovation, entrepreneurship, and capital, and then he's got trade. I was talking with the Minister of Budget earlier about the handshake between the ministries, because these themes are just spreading all over the place. So what do you make of it? What do you make of it?
So Rotus, I'll try not to ensure our viewers are then confused further with the extras, in the complexities in this. First, I must mention that collaboration and partnerships will be so crucial to ensuring that he achieves the objectives. So the things around knowledge, around policy, also ensure, and there's a touch point on creatives, by the way, because when you look at the traffic we're driving in the creative sector, Nigeria is ranking top 5 in the TikTok traffic globally. In telephony, we're ranking top 5, which means we actually do talk a lot, and it just tells you that there's a lot of opportunity in this space. But coming back to collaboration and partnerships, recently, the Israeli government invested about $3.2 billion in Intel. Intel is a Silicon Valley company from the US, and we all know how the world is currently looking at the Israel-Hamas conflict today. So it tells you that if you don't have governments putting the right partnership arrangements and the right collaboration structures with the private sector, there's going to be a big struggle. So that's extremely important. The next bit will be, what are we thinking of around the emerging technology areas? And I know we'll probably get here, but AI continues to emerge as a key selling point for most companies globally. In Nigeria, Google Maps is probably one clear example where the intel is there and is guiding how people do businesses and commute. But we have to say to ourselves, how do we then ensure we can create opportunities off the back of this? I mentioned something about the creatives. For those who know the guys who are emerging and driving this traffic, Rema is someone who emerged just very recently. And less than 5 years of his emergence, he's got 1 billion downloads in Spotify, driven by TikTok, which means you've got to find a way to promote the communication sector a lot more and see that in the media space, we can promote our guys and find ways to also see how we can, enrich the economy a lot more. You hear the likes of Burna Boy, Davido, and Wizkid. These guys will charge $2 million per appearance on a show. How much of that is coming back to the country? So again, we've got to start thinking of how do we promote the kind of collaboration that helps us, mitigate the FX shortage that Ladi talked about earlier.
Okay, but Lawrence, let me follow up on this, and I know that we're still squeezed for time, but real quick, Spotify is a Swedish company. TikTok is Chinese. The Burna Boys, the Remas, all these folks, they live overseas, right? So do we need a platform here that's Nigeria made to where all these streaming services we can earn money that way? Because it doesn't, again, as you just said, none of this money comes back. If you look at GDP growth for the creative sector, it's like less than 0.1% or something. So how do we is it an infrastructure issue?
It is an infrastructure issue. So if you take two parts in this communication sector, the comms part of it is contributed over 10% to our GDP in the last 10 years. So averaging 12 to 14% average. The creative side, not so much. Ladi made a point earlier that from a cloud standpoint, it's Azure, it's AWS, it's Google Cloud, and none of these servers or data centers are in Nigeria.
Right.
So if we have it in South Africa, then I think we have to start reflecting again on how do we create the environment of just making sure that we have the opportunity to also host some of these cloud solutions here and promote the adoption locally.
Fantastic. Ladi, let me come to you. This question is supposed to be on artificial intelligence, but are we there yet? Because if you go to the website of the NCC, 60% of Nigerians are on 2G. 2G. I think the next one, 3G is 9.5%, 4G is about 29%, 5G is 0.8%. This is with all the hoopla around. So, broadband penetration is under 50%. My question was on AI. I was supposed to ask you how the government uses AI to leverage is that even an appropriate question at this time?
I think it's an appropriate question, right? There are two ways to look at it. You bring the dimension of the spectrum, the coverage, whether or not we have 5G, 4G coverage across Nigeria, which is relevant. But then part of the problems or part of the solutions that we're seeing in the AI space, especially when you look at generative AI, is helping to bridge some of these gaps. I think a couple of months back, you'd see when Humane, one of these AI companies, launched a device that basically abstracts the need for a mobile phone.
Exactly.
You know, so more or less, you'd see that the AI, where generative AI is today, is creating that fusion between voice, data, video, such that the way this, if it's well integrated, people with feature phones can actually have AI-driven interactions based on voice. During Satya Nadella's presentation, during one of the Microsoft events last year, he gave an example of how rapid AI adoption, the Indian government is adopting AI for the local farmers. And part of the challenge that you see that they try to solve there is that you have local farmers, semi or fully illiterate, that really don't even know what sort of government incentives, government investments or programs are available. And by leveraging AI, they were able to bridge that gap, because that then all of a sudden that farmer in that village is able to make a voice-based query about certain programs. This in this case was the rice farmers, and then you get a voice response. You know, so.
There's never enough time. I'm going to have you both on my tech show on our rise. Ladi Asuni, Lawrence Amadi, thank you so much for joining us to talk about tech. Very fantastic, involved, great sector. Thank you so much. All right, it is, of course, Budget Day 2024, right here at Rise News, KPMG. We have more, the manufacturing sector, discussion on that after the break, so stay tuned.
Yeah, we're live back at the KPMG Center here in Victoria Island, Lagos. This is the KPMG Arise Budget Day 2024. Now let's talk about manufacturing and consumer markets. Quite a very big story, and I've got two panelists here to discuss it with me. Both of them well-heeled here at KPMG. Let me introduce first. Ladies go first, Mohammed. So please allow me to introduce my first, your colleague, Ijoma, who is in charge of as a partner at KPMG. Thank you so much, Ijoma Emeze-Ezebo. And of course, Mohammed, it's good to have you here as well. I hope we can go on a first name basis.
Yeah, sure.
Great, thank you. Makes it a lot easier. When you talk about manufacturing, let's look at this, what you folks put together and show that to our viewers in terms of the nuggets around manufacturing and consumer markets for 2024. Inflation is hovering around. This is what inflation projection is. We're around 28.33 right now. But this is what the projection is in the New Year budget. Exchange rate is expected to be around 750. We're doing about 800 somewhat right now, oscillating around 1,000, 850. It is going in and out every day. At the Nathan market, by the way, I don't use the black market. I don't like the black market. But again, this is what it is. Projected revenue roughly 42%. Revenue from independent sources around 39%, and projected dollar revenue about roughly 20%. And if you look at the allocations just around my corner here, the far right of the screen is about 26 billion for the Ministry of Industry, Trade and Investment to power manufacturing sector, industrial trade and investment. That figure, you're going to tell me what you think with that can bite a little bit. That's 1.2 trillion. Oh, I beg your pardon. That's 1.2 trillion for infrastructure, works, power, transport, and water resources. Is that enough to share? That's 534 billion allocation to special development, poverty reduction, an additional 2.35 trillion allocation to defense and security. All of this together go into manufacturing and consumer credit, consumer market. This is very huge, as it were, when you talk about the country. This is the engine, the heart of the entire budget, whatever we're talking about. This is where we need to make the money. This is where we need to bring in the money. This is where we need to create jobs. This is where we need to create wealth. So everything is in here in the manufacturing and consumer market and how to boost Nigeria. So I'm going to ask you first. So when you look at this issue, when you look at the the FX challenges and all of that within that sector, what can companies look forward to this year in terms of this volatility in exchange rate? And if they can plan, what do you think they can plan with in terms of exchange rate? What can they hold down?
Yeah, so that's a very interesting question, boss, and thank you for that question. So when you look at the challenges that manufacturing sector has had in terms of FX, it's really been two issues. It's been the volatility, and it's been also the availability of the FX. So one is the volatility in the rate, which just makes it difficult for them to plan. And then the second one is whether the FX is available in the first instance. So I know you mentioned that you don't like the black market trade, but unfortunately, when we sit down with our clients, most of them are deferring to the black market to source FX because they need those critically to import the raw materials and the machinery that they need to get manufacturing going on. So that's one sector that we believe that the government needs to have some sort of, not just from a budgetary allocation point of view, but from a fiscal and integrated monetary policy. A combination of both should help them stem the issues that we have in the FX market. But beyond that, we also see, when we sit down with our clients, we see them trying to increase the level of export sales. A lot of them have gone into significant investments in this area. Flour mills of Nigeria, UAC, and most especially the multinationals, the likes of Nestle and the likes of the breweries, they've done quite a bit. But in spite of that, when you look at the numbers, for example, Flour Mills of Nigeria, which is leading this sector, Flour Mills of Nigeria still has 2%. It's only 2% contribution of export sales to the overall revenue, which is still very small. So what can government do to ensure that there is increase in export sales? So that beyond the availability of FX locally in the markets, the consumer markets manufacturing companies can increase their level of FX earnings to be able also to fund their FX requirements.
Interesting. I want to go to Mohammed, but just very quickly, do you think a weak exchange rate has some value in any way for industrial manufacturing if your currency is weak? Does it have any value, or is it all negative?
Whether your currency is weak or not, at the end of the day, it's down to your productive capacity and your ability to find the right markets and, of course, to have the right local market. Today, poverty in Nigeria is at the all-time high. If you have a low exchange rate and you still don't have the purchasing power for the local market and, of course, the ability to export into the foreign markets where you have your customers and your markets, you still won't have anything to do. You still be able to do anything with the weak exchange rate. So when you see the weak exchange rate in China, for example, it's down to the fact that they're able to benefit from the weak exchange rate to export, to drive their export sales to the US and, of course, to Africa, where we've almost become a dumping ground.
Japan the same as well.
Absolutely.
Exactly. So that takes us to the consumer market. 200 million people, as it were, and we're all hungry for something. We want new phones, we want food on the table, we want to look really nice, we want to enjoy the best of what our folks around the world have also enjoyed in developed markets. Do you think this figure, this money here, hanging around me here, it will be enough for us to stimulate consumer spending in Nigeria as we see exchange rate, inflation weakening consumers' pockets almost on a daily basis?
Yeah, thank you very much. When it comes to stimulating consumer spending, we're talking about purchasing power. And if I look at what you've just shown there, the budgetary allocation, allocating 534 billion towards social development and poverty reduction, you don't achieve sustainable increase in purchasing power via handouts. It won't happen. You've got to create the jobs. And today, there are things that the government can do to create jobs, is to empower the private sector. And how do you empower the private sector? Is by creating the enabling environment. I like being practical. If you look at today, we have car assemblers in Nigeria, right? The government today is one of the biggest buyers of cars, right? And recently, if you look at the number of cars that we have to buy for our public, servants, huge number of cars. There are two implications for that. First, there's no single supplier that can provide or supply the number of cars. So that means they have to import those cars. So you put additional pressures on the FX that you don't have and that should have been available to manufacturers. And so if you, growing up in this country, right, I used to see Peugeot as the official car. To me, growing up, it has seemed Peugeot was the official car of the public sector.
Of the Federal Republic of Nigeria.
Yes, of Nigeria.
Exactly.
Assembled in Kaduna.
Yeah.
Today, that's not the case. And so if you have a government policy that says, hey, all government functionaries, right, you have to use cars that are assembled in Nigeria, made in Nigeria cars, that could have a huge impact. And that's how you create jobs. Because you have businesses in Nigeria, all these car assemblers, you enable them. They have to hire more people. Those cars will be maintained here in Nigeria. It will have a multiplier effect.
So you think creating jobs goes with a nexus to higher consumer spending?
Exactly.
There's that nexus there?
Yes, there is.
So please go ahead, finish up on that.
So you have, for you to be able to do that, it's really not about the budgetary allocation, but it's about the policies and how effectively the government is implementing, being deliberate about the implementation of those policies. If you have people support the private sector, right, supporting the private sector, you don't even need to spend money to do that. And I'll give you an example. If you take the aviation sector, for instance, in Nigeria today, we don't have a national carrier. Most countries don't have, which is not a problem. But if you have a private carrier that has demonstrated capacity for international flights, you can simply designate, such a carrier as your national, such a private, carrier as your national carrier, and they can take or benefit from the various bilateral air service agreements that you have with other countries.
Shares in it. Just the way government is owning shares in Dangote Refinery.
Exactly.
20%.
If you like, you can own minority shares.
Yes, minority shares. And then government will get to claw dividends.
Exactly.
And whatever.
You get dividends, you create jobs, and that's how you do it. Handouts won't go far.
How will go far? I love the policies you talk about creating jobs and external. But again, the EFCFTA is here, whether we like it or not. We have to be part of it. Some has been talked about. It's taking off. Looks like it's cruising at a very low altitude. But we have to be part of it. 200 million people, largest economy. Everybody in Africa is looking forward to Nigeria to be the ringleader, to take the ringside seat in the AFCFTA. So when you look at the budget here and what have you, do you think we have what it takes? And Mohammed says, it's not just about the money, but deliberate policies and actions. How do you think we can work that out?
Absolutely. And thanks, Mohammed, for that. One of the things that I believe is that the AFTA would go beyond the budgetary allocation. So the whole objective of the AFTA was to increase intra-Africa trade. Today, intra-Africa trade is at a low of 18.6%. Intra-Asia trade is at 67%, and intra-European trade is at 72%. So we want to get us to the 20s, to the 30s, and hopefully to the 50s. And what do we do? It's not about budgetary allocation, yet it's still about implementation. When you sit down with the clients and ask them questions, what do you think you would benefit from this intra-Africa trade? So 2 challenges. The government is first worried about the tariff loss in tariff revenue. And of course, the players are worried largely around the uneven distribution of costs and benefits. If Nigeria, if we don't get our macroeconomic issues together, we are not able to stimulate export from our manufacturing companies. We'll be at the receiving end of this whole policy. So you will have Nigeria, because we are not producing enough and our productive capacity is shrinking, you have more imports coming into Nigeria, and of course that would further widen our trade deficit. So what do? We need to, first of all, I believe the government needs to start engaging proactively the organized private sector, especially the manufacturers in the consumer space. What do they need to do? They first of all need to harmonize the tariff guidelines so that at least there's clarity in what the tariffs are, and then have some policies around the non-tariff guidelines. We need to look at trade facilitation. We need to have information on how people can move, how goods can move. Today, you want to go to Ghana, you want to take some things into Ghana. Oh, government, the guys at the customs will tell you can't take this, you can't. Why is that information not available so that there is clarity on information that can facilitate trade in Nigeria? And of course, lastly, how do we boost our productive capacity so that we are able to export rather than be the ones importing?
And how to boost that is my question. Next question to you, Mohammed. In terms of the infrastructure that we need, and when you talk to every manufacturer in Nigeria, whether big or small, first is about money, funding or financing. The second one is our infrastructure, and vice versa, depending on who you're talking to. So that's very critical. So we have this, so as we're looking at, are you looking at allocation to infrastructure, 1.2 trillion. And we know that, and the minister said that we need about $100 billion every year to fund that, and Minister for Budget was just talking about that. So works, power, transport, water resources, 4 critical sectors. Can you share this? You have a calculator there. Just share this one. Just divide this for me. How much each ministry will get? I'm sure one of this ministry will swallow the entire figure. I'm sure.
Yeah, so if you divide it by, I think there are 4 ministries there. That's an average of 400 billion
for each.
For each ministry. And when it comes to infrastructure in Nigeria, right?
So we need the private sector here.
Exactly. We have a huge gap. And if you look at, for a developing country like Nigeria, with our growing population, our population rates, the rate at which you're going is over 2%.
Yeah, outpacing our GDP.
Exactly. And so with a growing population rate, your investment infrastructure needs to be growing. Now, when I look at the midterm expenditure framework, the plan in the midterm expenditure framework is actually a decline. The current the allocation, to infrastructure, the four of them, is about 32%, right? Next year, based on the midterm expenditure framework, that figure will go down to 27% in 2025, and in 2026, it reduces further to 25%.
To the end of the current MTEF period.
Yes, exactly. And so, first of all, there is that concern that we are underinvesting in much needed infrastructure to support the manufacturing sector. That's clear. That itself is not necessarily a problem if you then create an environment where you can attract private capital, into the sector, and which is what we need. We need private sector participation. So it's now for the government to create the enabling environment, free the sector, so that you can attract private capital, private investors into these sectors. And you have specific sectors that are actually, that you can attract private investment into. The rail sector, the roads, those are sectors that you can package depending on the model, whether concessions, and you can attract, but you need first of all to fix internally as a government, you need to fix all the issues that needs to be fixed.
Interesting. And talking about fixing those issues, and I'm sure, Ijoma, you're in charge of you lead transactions and deals advising KPMG, so I'm sure you're the one who get the calls sometimes from these investors say, hey, they want to come in, they want to get out. And when you see them leaving the country, I'm sure you're heartbroken in a manner of speaking that, what have we done wrong to see them go? And we're losing them to other jurisdictions. In fact, we find companies that exited Nigeria and still doing business in other parts of Africa.
Absolutely.
Very interesting.
Yeah.
Bata, for example. Bata, for example, is still on the Nairobi Stock Exchange, for example, as a listed company. Ever-ready batteries. And we all had that in the 70s and 80s. So, Ijoma, what do you think we need to do to court these investors and retain them? When you say I do, or when we say I do to these foreign investors, how do we keep it up?
Sure, absolutely. I mean, you talked about the companies that exit Nigeria and continue to do business in other parts of Africa.
Yes.
But these companies that are exiting Nigeria still continue to do business in Nigeria. So that's the interesting part
under
of this. Under a different model.
Arrangement.
So they have a third-party distribution model where they are still selling their goods and products in Nigeria. So the reason why they're leaving the country is not because of any demand issue, it's just because of the ease of doing business in Nigeria.
Removing manufacturing footprint and going to this just simply third-party distribution.
Absolutely, which is very bad for us as a country, right? So when you look at the challenges, and this is not just manufacturing, we had in the earlier talk about the agriculture guys who are closing business.
Yes.
When you look at that whole manufacturing value chain, it's become very challenging. It's become very challenging over the years. A lot of the manufacturers in Nigeria at some point had to be financed through imported capital, right? And still today, that's where you have the deals that are coming in. Investments, a lot of them relied on foreign investments. A lot of them borrowed from foreign lenders because we had challenges in the local economy where the cost of debt in Nigeria was in the double digits, way high double digits, 20%, 30% sometimes. Now, with the Naira devaluation, it became almost impossible for them to continue to operate importing their raw materials. So a lot of them had to be subsidized by their operations in other countries. Now, when you look at, for example, when you look at GSK, the contribution of GSK's operation, of Nigeria's operation to the global operation, it was under 1%. So it didn't make sense for them to continue to endure the challenges of doing business in Nigeria while continuing to be physically operating in the country. But we have a long way to go, and government has a lot of policies that they need to put in place to ensure that this does not continue to happen. And this is really, at the end of the day, one of the things that we say, I recall the thought leadership, where we looked at investment flows within the region.
Yes.
And the end of the story, or the conclusion of the summary for us of the finding, is that capital will go where it has the highest risk-adjusted return. Nigeria's risk profile for the returns that is coming out of the country is very little. When you look at the investments in energy, which is where a lot of investment has gone at 40%, and you look at consumer at 80%, 20% is really because of consumer markets at 8% is down to the challenges across the value chain, whether it's agriculture, whether it's access to capital, whether it's really just that enabling environment, fiscal and monetary policy, export opportunities for the sector, all that needs to come together. I recall a couple of years ago, the federal government had implemented the export expansion grant, EEG.
Yes.
You all remember that?
Yes.
It really encouraged a lot of the manufacturers to seek to export out of the country.
Exactly.
I remember sitting down with flour mills those days. It used to be a significant part of the likes of flour mills, the likes of the breweries, Guinness at the time, a lot of export going out of those businesses. But when the EEG was scrapped in 2014, it was reintroduced in 2017, but didn't quite work, right? I'm hoping that this is something that the government can consider. We had heard that there were some conversations around reintroducing some sort of incentive to drive export, but we can't find any aspect of it in this current budget. I think that's something that government needs to. We need more clarity.
And that
we
you
need
think
more
should come from the Ministry of Industry, Trade and Investment?
Absolutely.
Exactly. And the agencies under that, that's the NEPC and the rest of them. And we talk about the GSK and a few other countries, other companies live in Nigeria or foreign investors. Do you think we can replace each of them? If they exit, for example, the GSK, which is a pharmaceutical industry, do you think we can move in and set up our own pharmaceutical industry, perhaps using local research, local material, raw materials to make some of those drugs? Do you think the government can just take that as a challenge? Just replace, maybe just a few years down the line? Or how do you think we should support local industries to fill those gaps?
Yeah, I think it's really around the support, not government doing it directly, but supporting, private sectors to fill those gaps.
Yes.
Well, looking at that, and I think I just spoke about some of the issues already in the manufacturing space. All the problems, the ease of doing business, we are not where we should be. And we should always remember that when it comes to investment, whether local or foreign, you are in competition with people. And if you create bottlenecks, capital is going to go to where they find it easier to do business and where they can find the highest returns. So in terms of supporting the private sector, there is a lot the government can do. Today, for people to even come in, there are all sorts of barriers. Ease of doing business is not just about registering a business in 24 hours. It's far more than that. You go to our ports today, you want to import the manufacturers to bring in product is a problem. It's all kinds of barriers. It's the same thing for exporters. So if you want to start, to provide the right environment, is first of all, dismantle all the barriers at the ports. Make it easier for people to bring in the raw materials that they require, the machinery that they require. Make it easier.
So there's a tax waiver that Mr. President is just thinking about for bringing in equipment in the in the mining sector. You think that's a good signaling?
That's good. That's a step in the right direction. But given where we are today, we need many steps in the right direction for us to make progress.
An expansion beyond the mining sector.
The mining sector. What other sectors do you think, manufacturing, do you think we should focus on? I'm sure you want some deals, by the way, in German.
So you mentioned pharmaceuticals. Pharmaceuticals is one critical area. So a lot of the DFIs are investing in Nigeria being self-sufficient in the manufacturing of the active pharmaceutical ingredients, APIs, which is a critical raw material in manufacturing of APIs. So that's one area that we're taking a bet on. We would hopefully see in the next couple of years, once that's sorted by the DFIs, an increase in manufacturing base in the pharmaceutical sector.
Whatever deal you're making this time at KPMG, let me be the first to know in the new year. Both of you, by the way. Thank you so much. It's great to have Mohammed and Ijoma. Thank you very much for speaking to manufacturing and consumer markets at the Arise KPMG Budget Day 2024. We'll be right back, everyone. We've got some of the biggest names to wrap up this programming. We'll be right back into Standby.
Welcome back to Arise News and our special coverage of Budget Day 2024, the collaboration, the second year in a row between Arise TV and KPMG. As always, we are live in the KPMG Insight Center here in Lagos, Nigeria, and all good things must come to an end, unfortunately. It's been a lovely, lovely day, invigorating conversation, but we've got one more to go, and we're happy to have Mr. Olani Yusuf, who is the chairman of the NESG, the Nigerian Economic Summit Group, and of course, the gentleman who kicked things off and laid the foundation for today's conversation, Tola Adeyemi, Senior Partner, KPMG Nigeria, also CEO, KPMG West Africa. Gentlemen, thank you so much for being with us to round up everything we've heard. Mr. Olani Yusuf, the NESG, you have spent, just like KPMG, you've provided advice to the government, you've analyzed the economy, you've given out lots of metrics that should be focused on. What is your takeaway from everything you've heard today?
Right. Interesting session since the morning, and I think it's been a very good use of my time. So a number of things. First is, this is a very ambitious budget, right? In terms of revenue numbers, 19 billion revenue, of which 19 trillion revenue, of which 9 trillion of that should come from the oil sector. Now that is massive. So that assumes we must deliver on the 1.7 million barrels per day, and like we've been told, a number of things need to be put in place for that to come into fruition. And so an ambitious budget, but I'm happy with a few things. First is, we have about 39% of that focused on CAPEX. So it's been a long time that CAPEX has been in the 20% range. Now it's about 39%, almost 40% that are going to CAPEX. Well, about 12% focus on security. Yeah? If we don't assure the security of lives and assets, you're not going to get development. And so that is encouraging. We have about 15% of the budget focused on what I call human capital issues, health, education, social infrastructure, right? So again, that gives hope. Okay? And like we've heard from all the speakers, the private sector is ready and willing and able to bring capital. But concerns around government efficiency, how are we going to ensure that this spend, the quality of spending, it's improved. Concerns around security, concerns around the oil production volume, how are we going to meet that? We need more incentives to attract private capital, and not just foreign capital, but also domestic capital. All right, and so how are we incentivizing and attracting capital? That is important. Ease of doing business, that also needs to improve dramatically. We've seen a number of exits, even though those exits are based on decisions taken in the last so many years. Right from the Obasanjo regime, we've been trying to fix power. Right, 23 years after, we're still trying to fix power. And so there has to be pace in terms of how we improve the ease of doing business, how we improve power supply, and of course, how we ensure that regulations really promote and support the private sector, and not that regulation is seeking to make the private sectors, where regulators then become revenue and they have revenue targets. So we need to flip all of that. And I think those are some of the things that for me have come out. And I hope that if some of those things are put into place, then a large chunk of the 28 trillion budget can be implemented.
Thank you so much, sir. Mr. Tola Adeyemi, you set the ball rolling this morning with your fancy electronic wall here, taking us through the numbers and breaking everything down. What's been your takeaway from today?
Thank you, Rotus. A number of things have come out from the discussion as I reflect on what I've heard this morning. So I've heard a lot around implementation, the need to now move, in a sense, to deliver on the hope. We've got to move to action. So I heard a lot about having detailed work plans and executing on those work plans. I think that's going to be important for government to do in order to deliver on the promise of this budget. The other thing that comes out quite clearly, as Mr. Yusuf mentioned, is the fact that government cannot fix the problems of this country alone. Private sector investment is required. So when we speak to our clients, they keep asking us the question, what are the specific things that government is doing to help us, businesses that are here in Nigeria? And some of them say, we're waiting for a detailed action plan on that. So I think really focusing on the things that are needed to stimulate the private sector. They're enabling the business environment. That's got to be a key priority of government in order to really get this economy going. The other thing I will talk about is macroeconomic stability. Many of our clients are grappling with just the volatility that exists on many key indicators. Of course, FX is one of them. The other day I was speaking to a client and he says, look, I'm being turned from a manufacturer to
currency speculator.
Yes, to a currency speculator, you know, and that's what we're spending our time doing. So he says, I don't care what the rate is, I just want it stable. So achieving macroeconomic stability, I think, is another key priority and an area of attention in terms of the themes that are coming out from our discussion today.
Fantastic. All right, we're out of time, but I do want to get an outlook on the economy from you both. Are you cautiously optimistic? Are you, Mr. Alani Yusuf, as we wrap up, what's your outlook for 2024?
I'm quite optimistic that 2024 will be much better than 2023. I think the things that needs to be done are clear, and I think we have seasoned administrators behind the wheel, and so I'm quite optimistic.
Mr. Tola Adeyemi, what's your outlook?
Nigeria is a country with huge potential. I think, you know, we've all got to remain optimistic about Nigeria. But to fuel that optimism, we need to move from hope to action.
Yeah. Mr. Tola Adeyemi, Senior Partner KPMG in Nigeria, also CEO KPMG West Africa, Mr. Alani Yusuf, Chairman NESG, that's the Nigerian Economic Summit Group. Thank you both for wrapping up this bow on what has been a great day. Thank you so much. Ladies and gentlemen, that brings us to the end of the Budget Day 2024, brought to you by Arise TV and KPMG. It's been an awesome day. Don't forget, at Arise TV on X, also at KPMG_NG. Thank you so much. I'm Rosu Sodiri. We will see you in 2025.